Like in every statement of yours, I can feel the underlying belief in India's potential.
What else we need that we see a strong bull run in coming months or maybe coming years?
And since then, India has just been and continues to be our top pick as a global strategy along.
But how important do you think are going to be this GST reforms? It's 11, and we can start the formal introduction. There are about quite a few people who have joined. And of course, you don't need, frankly, an introduction. Everyone is really looking forward to hear from you and learn from you. But here goes your formal introduction.
Okay.
Mr. Jim Walker is the chief economist at LTR Capital Limited. Prior to joining, he was the founder and chief economist at Asianomics Group, an economics and strategy research consultancy formed in 2007, primarily to serve the fund management industry. Prior to establishing that, he was chief economist at CLSA Asia Pacific. And during that tenure, he came up with many groundbreaking reports, predictions, as also numerous times got awarded as best economist across Asia Money, institutional investors, and many more such surveys. His views on India are very sharp and positive, and also on some of the largest economies in the world. So we are very keen to know and understand from you why you have these views, and also will be inquisitive enough to ask you questions once your presentation is done. Over to you.
Very good. Thanks, Amisha. That's very kind words indeed. But I want to start with a quick presentation on partly the United States, just to put it in context just now. I'm just in the conversation with Amisha a few minutes ago. I think I'll mention China and try and put it into a context in relation to India, and then spend a couple of minutes on India itself, and then we'll be asking lots more questions about India, I'm sure. So let me try and share my screen, and hopefully you can see that
yes, we can
logo at least now. So if I then move on to very quickly, just as regards the United States just now and where we stand, and it tends to change almost every week because we don't know what Mr. Trump's going to say from day to day, and we have very little real kind of insights into where data are going in the United States just now. We obviously had CPI numbers that came out yesterday. And earlier in the week, there was a massive revision down to some of the employment figures, the non-farm payrolls numbers, which had been released between 2024 April time and March this year. Those employment numbers really invigorated the markets and signaled that the Federal Reserve will cut interest rates next week. And I think that's almost, in fact, I think it's a certainty that there will be a cut in interest rates next week. But I was very surprised yesterday when the CPI numbers came out from the United States, which were actually worse than expected in the sense that they were higher. And yet the markets just ignored that and said, well, we're definitely getting an interest rate cut next week. On employment trends, I think that's justified. On inflation trends, it's certainly not justified. And I'm going to try and show you that that might cause some problems down the line. However, the main thing that I want to say is that the biggest characteristic at the moment of the United States is unpredictability. And of course, that's really to do with the president and the president's policies, and specifically tariffs. That unpredictability raises uncertainty, not just in America, but in the global economy. And unfortunately, when uncertainty goes up, investment goes down. And I think that's the part of the equation that we haven't yet seen, both in the United States and in some other parts of the world. But I think that's the very strong likelihood for the remainder of 2025 and into 2026. One of the main reasons that we haven't seen it in the numbers yet is just that because there was so much talk about tariffs, and then the tariffs were imposed and then they were delayed and blah, blah, blah. Everybody tried to get activity and get imports into the United States before the tariffs took effect. And so economic activity was brought forward, if you like, into the first half of this year. The outlook, as I suggest, is, I think, probably a bit more dangerous. I've mentioned in that second point there, tariff revenues are bolstering government finances in the US, or so they keep claiming. But who actually is paying the tariffs? Is it the producer, which is the foreigner? Or is it wholesalers and retailers who are in the American space, or consumers? Well, the evidence from the first tariff war in 2018, 2019 between the US and China was basically that only a minimal amount of the tariff payments came from the producer. Nearly all of the payments came from the wholesaler and the retailer and the consumer in America. And if that is the case again this time round, then all the noise and all of the claims by the government in the US that these tariff revenues will boost economic activity are wrong, because it's just a transfer of economic activity from the private sector to the government sector. And I would always argue that that will reduce the likely outcome of GDP growth rather than increase it, because the government is a much poorer spender of our money than we are. I want to maybe just quickly mention producer prices. I'll do that in a second, but in that last point, as I said earlier, Fed funds rate will be cut next week. The big question is whether it will be cut by 25 basis points or 50. I think it's much more likely to be 25. I mentioned producer prices there because it's another way of looking at inflation. Obviously, we tend to focus more on consumer prices as regards the inflation outlook, but producer prices are quite important as well because they feed into consumer prices. And one of the things that I was struck by, the chart on the left-hand side, looking at producer prices in the US for the last 3-4 years, actually looking back a decade, but in particular the last 4 years. In no time frame have they come down to be negative on a year-on-year basis. In other words, prices went up very sharply, and then there was no reversion to anything like a mean in the United States. That's very unusual for producer prices. And if you look at the chart on the right, what it's basically saying is that in the United States, producer prices are the highest in the countries that I looked at on that chart. But that means most of the European countries, most of the advanced economies, and the big economies in Asia. The latest producer price figures brought it down to about 2.6%, but that would still be the highest number out there. And the trend is rising. And what that's really saying to me is that the upward pressure on prices generally in the United States has not abated. And that was certainly true from the CPI number that came out yesterday. I don't think I'll mention very much on this issue of tariffs because we're going to talk about it in the India context in just a minute. But I really want to re-emphasize the problem that the US now has about inflation. Because in 2018, 2019, when they imposed tariffs on China, the one thing that accompanied that tariff imposition was a strengthening dollar. And with the strengthening dollar, there was no pass-through of the 10% tariff increase to US consumer prices. And the assumptions that were made in terms of the tariff strategy this time round were that the same thing was going to happen. that the dollar would strengthen. That would offset some of the tariff increases, and the US would not have any inflation issues. Well, in actual fact, the reverse has happened. The currency has depreciated, which automatically means higher import costs, never mind tariffs. The increase in the reduction in the dollar has already had an impact, and I think that's why the producer price numbers look the way they do on inflation in the United States. And when the tariffs really kick in, there will be a further problem with inflation. And what that then means is that the US might have exactly the same problem as the UK. So I'll show you that just in a second. The first chart there just is the broader exchange rate in the United States. So it's not against one single bilateral currency. So it's the real effective exchange rate, the nominal effective exchange rate, trade weighted against all countries. Effectively, the dollar peaked almost the day that Donald Trump took office on that left-hand chart, and is down 8% since then, which means, in other words, most import costs are up 8% in the United States. But if I'm right about the inflation problem, the biggest danger is the second chart. The second chart has nothing to do with the United States, it's about the UK. But what it shows is the government bond, the 10-year government bond yield against the official interest rate in the UK. Over the last year, that base rate has been cut 5 times, 125 basis points. And the 10-year government bond yield over the same period has gone up 75 basis points. In other words, the market ignored entirely the government's efforts to cut interest rates. And I think that's the real danger for the United States just now. If inflation continues to manifest itself, in fact, if it goes up from here, and the government doesn't slow down its spending, which it certainly doesn't look as if it's going to do, the bond market will just ignore interest rate cuts. So just be aware of that if we're thinking in terms of investments, because interest rates are coming down. They might be coming down officially and maybe not unofficially. So I'm not going to go through all of this, obviously, because we're going to be talking about India mainly here. But I do want to just show you one chart from China and then go on to India for a second. That chart there is a very interesting one. And you'll see why it's interesting when I show you the same chart for India. What we try to do at Asianomics is look at the profit cycle around the world in different economies. But we don't get profit numbers very easily from especially emerging markets. So we use a proxy for profits in the economy, and that proxy is the return on equity in the stock market. We need to interpret the chart a wee bit differently from if we had actual profit data. But what this is really showing you in China is that the profit cycle has been dire for the last 2 years. And in 2025, it's no better, maybe even slightly worse than was the case in 2024. However, last week we introduced for the first time a global strategy long on the Chinese stock market through our Alethea publications. And the reason for that is that profit recessions don't usually last any longer than 2 to 3 years, because during the process of the recession, creative destruction starts and companies are shaken out of the system. And that's exactly what's happening in China just now. So this is a good time to be buying Chinese stocks, because next year profits should start to rise really quite sharply. Now, let me just quickly go into this chart in India, because if you remember what we've just looked at in terms of ROE in China, in India, the picture is entirely the reverse. India's profit recession was in 2019, 2020. Now, 2020 was obviously COVID, but 2019, when other countries were actually doing quite well, in terms of ROE and profitability, India was doing badly. And if you remember, that was basically because the banking system was problematic, especially the public sector banks. The bad debts in the system had gone high, confidence was low, and the economy was struggling a bit as we ran into COVID. But under the guise of COVID, the government, I think, did something quite brilliant, which was it used that smokescreen to recapitalise the banking system and consolidate the public sector banks. So we went from 27 public sector banks to 12. And it gave the springboard to the economy as it recovered from COVID to have a banking system that could supply money to the economy, whether it was partly financing government capital expenditure or financing the private sector, including lending growth to households. And India's lending growth in the last few years has been the highest in over a decade. That was because everything was sorted during that profit recession. And then we've had this tremendous upswing in ROE in India. Now, some people look at that and think, well, it can't get any better. I think that's wrong. And let me just try and explain very quickly why I think it's wrong. Here's where we stood with government spending in the first chart here. Everybody got very excited about India when, after COVID, the finance minister announced big increases in the capital budget within the Indian government budget. Around about 20% increases in the first year, 16% increases in the second year. And then in the last budget, earlier this year, the increase in the government expenditure and capital was only 5%. And people got really quite concerned about that things were maybe going to slow down as a result. But actually what had happened was that government capital expenditure had reached its limits, and that's all that happened. The economy couldn't absorb any more spending on railways and roads than was taking place in basically 2023-24. So that's why the capital expenditure side slowed down. Now, as you can see from the second chart, it hasn't had an impact at all on the PMI. In India, that remains the best PMI in the world. Almost too good to be true, I think, sometimes, but compare it with the China official manufacturing PMI, which has been very soft, obviously, for the last 3 or 4 years. India continues to do very well. But what happened with the capital spending reduction is that it then gave the government scope to begin the process that really has to happen in India. And you might wonder why the heading in these 2 pages are cutting the Gordian knot. That's a reference to the report that we wrote following our visit to India earlier this year. The real focus of this government for the next 5 years is reducing red tape in the system, reducing bureaucracy, increasing the ability to do business easily. And that's going to be the real firing point for a private sector investment cycle in India. That picture on return on equity in India, I think, is actually going to improve over the next 3-5 years, because I think the growth rate could easily be going. Our projection for this year, by the way, for fiscal year 2026 is 7.4% for India. I was saying to Amisha just before we started, I think that could easily get into the 8 to 10% range if businesses really generated are not encouraged to spend because it's much easier to do business. The moves in GST over the last couple of weeks are a big step in that direction. I think there's a lot more to do. And the intriguing thing to me is that since there's no COVID around to help the process along and to make sure that people, especially bureaucrats, know that they have to make a change in their attitude to labour laws, Companies Acts, Factory Acts, etc. The 50% tariffs that are being placed on India at the moment might well just be the catalyst to a revolution in Indian business sector activity through cutting red tape at the bureaucratic level. The real lending rate is very supportive of capital expenditure in India. I could explain that to you later if you want to ask questions about it. But I think the real thing to be watching for now is a big stride forward in a reduction in bureaucracy and a reduction in red tape in India that will put us onto a growth path that hardly anybody can imagine just now. So that's longer than I intended to speak, but let me open it to you, Amisha.
Thank you so much. While this is very heartening to know, and of course that we know that in comparison to China, the ROE of our businesses put together is very strong, and it is aided by both the very strong demographic, which gives it a very, very long view, at the same time sustained policy reforms, and so to say timely. Here in India, we say that tariffs can change whatever US has imposed, but the GST reduction is here to stay. So it's in this crisis that we gave birth to a new economic equation within India. But how important do you think are going to be this GST reforms, and of course initially aided by tax reforms, so making our broader economy very competitive? How would you view that?
Yes, I mean, it took a long time, almost a decade, to get agreement about GST between the states and the centre. The GST and the mechanisms that India has enacted to make sure that states don't lose out has worked really well over the last 7 years since it was enacted to begin with. But the thing that always worried me about India's GST was the complications of so many different rates. Because the beauty of a GST is usually if it's a single rate and relatively low, that just makes everything much easier. Now, I understand why there were multiple rates, and I understand the cess mechanism as well, just to begin the compensation process during a transition phase. Now we're kind of over that, and although there's still compensation guaranteed to the states for their for the payments, the way that the system works, I think going to 5% and 18% is a huge move that will really make GST. I've seen all the estimates about 93,000 crores loss, a net loss of around about 48,000 crore. I think what you'll find in the first year of the 5% and the 18% tax take will go up in India. The GST will go up because this is going to stimulate business activity, and it'll stimulate it, especially with the 5% rate being applied across agricultural machineries, consumer staples, consumer durables. This is an excellent first move in making taxation much more easily collected, but lower, and boosting the rupee in people's pockets.
That's excellent. You know what? Throughout last 10 years, and particularly in last 5-7 years, we continued to position ourselves as China +1. But somehow we didn't get that huge manufacturing leeway that we were expecting, is what we think. The whole economy was still largely supported by government spending, be it in defense, be it in infrastructure, but it was main, and private sector had not yet bounced back in terms of their capex. And what they critically look at is huge demand coming in. So do you think that we are on that cusp where post this GST, it's the private sector which will also see their utilizations at those levels where they will be triggered to take the Capex cycles.
Yeah, absolutely. And the funny thing, Amisha, is that the fact that the private sector hasn't really been driving Capex for the last few years just means that more and more Capex needs to be replaced, needs to be upgraded, needs to be expanded. So, if this will happen anyway, but making lowering the taxes, making business easier, keeping economic policy the way that it is, both at the government level and at the central bank level. I mentioned that real interest rate to you. A lot of people will calculate the real interest rate in India using the inflation number. We calculate it using the nominal GDP growth rate, because what we're trying to understand is whether investment in a company that can meet the growth rate will actually have a return. So the interest rates are actually quite low in India, but I still think they're going to go lower again. Our forecast when we published the note in March was that on top of the 25 basis point cut in February, there would be another 75 to 100 basis point cuts in India during this year. Well, we've had 75, and I think we'll get to my 100 forecast, and we might even exceed it, but probably not. That's very appropriate just now. As I argued in that note, policy making in India at the fiscal level and the monetary level has never been better. So it's now all up to the private sector, and to aid the private sector, the government sector in the form of the bureaucracy has got to make it much easier for companies to operate and do business. So one of the best examples that I was trying to, I found when I was speaking to people, the limits on the number of employees. And India has huge numbers of companies that have 9 employees or 19 employees. Because if they go to 10 or if they go to 20, they become
the regulations
subject to regulation. And to be quite honest, I would move that to 50 or 100, and you would just see an explosion in activity in India. But it's very difficult to get bureaucrats who can quite often benefit from these rules to change the rules. But that really is what needs to happen. And I think, as I said earlier, the imposition of tariffs, which might be able to, the government might be able to use that as a lever on the bureaucracy to say, if we don't get the domestic economy moving, we're not going to get a growth rate because the external economy could be troublesome.
Correct.
So hopefully this is a great opportunity to get things changed at the Factory Act level and some of the other industrial costs of business. One thing I should probably mention as well about foreign direct investment in India, and everybody kind of talked about China +1 and why hasn't India become the +1 in a bigger way. India has some logistical problems. There are only, if I remember rightly, 3 deep water ports that operate. There's Pune, I think Bombay, and somewhere else I've forgotten.
Yeah, Nhava Sheva and...
Because the continental shelf in India is different from some of other parts of Asia. It's much harder to get a deep water port installed because it would take huge amounts of draining and cutting away at the continental shelf to deepen the water enough for the big container boats. So India was always going to have a bit of a problem in becoming an absolutely, would you say, fierce competitor in the manufacturing industries, where manufacturing required shipping transport. Now, when you look at India as regards technology, or things like iPhones, you don't ship them out on boats, you ship them out via aeroplanes, so that India has no problem in that respect. So it's a tremendous competitor for high-end manufacturing, but it does have logistical problems for the lower end.
This is such deep insights. And I take this opportunity to introduce my co-host today, Mr. Anil Singhvi. One of the reasons I'll tell you, while Anil Singhvi from Indian parlance doesn't need at all any introduction because he's the managing editor of Zee Business, and daily millions of investors keep seeing him and learning from him. But one of the reasons for making him co-host, and I'm really thankful that he's co-host with us, is that your insights and your deep belief in India's policy regime, with his presence, I'm sure will spread larger and wider, and all those retail mutual fund investors who are continuously pouring their SIPs into the mutual fund, allowing the capital formation in the economy to really become good, will further spread as a big voice with high conviction, who's seen how the world policy regimes have changed, is connected by him to all the larger participants. Anilji, one question from you.
Yeah, sure. And good morning, everyone. Amisha ji, thanks a lot for your kind words and introduction. It's always such a pleasure to listen to Jim sir. I listen and watch all the interviews, and what kind of insight we get is really amazing. You have such a strong hold on Indian economy, Indian markets, even Indian policies and everything. Pleasure to host you, sir. And my apologies that I could join in a little late. I was in a live show actually, so just got out of that show actually. So one thing I wanted to know, sir, like see, in India we don't have any company like Apple, Nvidia, IBM. We have so many IT companies, software companies, to some extent some product companies also. But why India can't produce companies like which we have in US? We don't have Apple, we don't have IBM, we don't have Tesla, Nvidia. Where are we lacking actually?
Well, you know, the funny thing about that, Anil, is that I think if you went to all of those companies that you've just mentioned and looked to see who was in the top branches of the business, especially engineers and the
They
creators.
were all Indians.
They're all Indians.
It's the environment that needs to be changed. Sir.
That's even more painful actually. That's more painful actually.
Yeah.
That Indians are running those companies, but in India we don't have them actually.
Yeah, but you know, I go back to really what I was trying to say earlier about the ease of doing business and the obstacles that are placed in front of Indian companies when they get to a certain size, and then it becomes just a huge amount of red tape around about companies. It's much easier to escape and go to a country that things are very easy to do than to actually tackle the problems of bureaucracy. You know, to be quite honest, the UK is every bit as bad. And we see the way that bureaucracy and the government is actually suffocating economic activity and growth in the UK just now. And it's a real question and a real hard nut to crack for a country to really kind of delve down and break open the bureaucracy and the bureaucratic problems that surround business. Now, I think India is on the cusp of doing that. It's too late for the UK. It's gone. But that to me would then start to. We don't know what the names of those companies would be that would sprout up as global leaders from India. But there would be plenty of them if it was just so much easier to do business in the economy.
Amisha, with your permission, I'll ask one more question.
Please.
Jim, one thing is there, like FIs continues selling in India. They are reducing their bets on India. On the contrary, our audience, which are retail investors of India, they are pouring money like anything, either directly or through mutual funds. Are they doing right thing, or are they falling into a trap? Because we understand without FI's support and buying, Indian markets cannot run. They may not fall, but they cannot run. So Indian retail investors doing right thing, or they must be very careful and cautious.
Yeah, this is a hard one because the problem is valuation, Anil. I think we know that. The valuations in India look challenging. Companies are high PE. What is required is that earnings have to keep growing and keep growing strongly to justify the PEs and the valuations in the market. And usually when foreigners are involved in those kind of markets, they'll take opportunities to sell when they can because they're taking profits and they're worried about the ability to keep going. Now, my view is that India has no problem in continuing to grow at the levels that it's been growing at and faster. And I think those market valuations are entirely justified. But I'm just one person. And I don't have billions of dollars under management to push into India, or I would be. There's a little bit of a move to deploy some money back into China, which had been ignored by everybody for literally the last 5 years. And that would be part of the money coming out of India. But I think that's really short term, and I think it's short term thinking from the fund managers who are taking the money out. That will reverse when India continues to show that it's delivering the goods.
Sure. These two were very good questions and replies for larger investment, audience of India. And this is very reassuring. I will come back a bit to economics, and I would like to know, how do you see when you said that this time US dollar may not appreciate and in turn may not help cut the impact of tariff onto consumers. But how do you think that Indian currency and also the rest of the currencies which are competing with India to move? Because one side here within India is very, very worried about our currency depreciating a lot also.
Yes, it's interesting because, of course, the rupee traditionally has been quite a weak currency. But that's reflective of the very much the inflation differential, which has been traditional between India and its competitors, but basically its markets as well. So India has tended to have higher inflation, and usually, and for good reason, that means that the currency weakens, because if it doesn't weaken, then competitiveness is going down. Now, I would say that was true traditionally, but more and more it's not true. Because one of the things that we try and look at Asianomics is not just the current account position, which is what everybody tends to focus on when they're looking at fundamentals on the external side of an economy. But we adjust the current account with net foreign direct investment flows. Because foreign direct investment has one aspect which is slightly problematic for emerging markets in that it tends to be very import heavy. Because when companies come into a new country, they don't have natural suppliers in that country. So when they're building the factory and putting the equipment into the factory, they buy it from their own country or from elsewhere. And that's a big import bill. So if you only look at the current account position for countries like India, you can get a misreading on what the real external fundamentals are. When you make this adjustment, you get a better picture. And actually, India's what we call adjusted resource gap is very, very small. Very small in terms of being a deficit. In fact, in some years over the course of the last decade, it's been a surplus. So my argument to our subscribers, our clients, our investors has been buy India, but don't hedge.
Okay.
Because the rupee might not appreciate, but it's not going to depreciate very much at all. I actually think India is in pretty good shape and the rupee's in pretty good shape.
But like what you said, that our policy regime is one of the best that we can have. If you ask me, our macro is also one of the best that we can have, both in terms of government finances, banks' health, bank balance sheets, and even corporate balance sheets. And even individual balance sheet is not so leveraged. And everything, and if that is why you also see CPI has been under a lot of check comparatively. What a decade ago, and now you see last 5 years, we've been much stable. So all the macro stakes up really well. But do you think that one of the key drivers of our job creation was IT? And now that AI has been making all coding and so on and so forth much more easier, we see that most of the large Indian companies are not hiring as much. Rather, they would be firing. So how the job market would really shape up, what would really help? While on one hand, yes, on manufacturing, the Capex has to go up, but will this stabilize in time? How the job market will work?
Yeah, well, I go back to the theme of cutting the Gordian knot. The easiest way to get the job market moving. Now, I think the GST, by the way, will be a big contributor. That's going to lift activity anyway. But the biggest way to get the job market moving is to reduce the challenges, the obstacles for businesses to expand. And that's really an issue about red tape and regulations. I'm just desperately hoping the government grasps this opportunity and uses Trump tariffs as the explanation and the reason for doing it, because that will transform India. And we don't need to worry about the IT sector not hiring people. There'll be plenty of other sectors actually exploding with business.
Certainly. Anil, one more question from your side before we open it to audience, please.
Sure. So, I mean, as Amisha just said, that we have everything in place on macro level, right? In terms of health and size of economy, policies, everything. What else we need that we see a strong bull run in coming months or maybe coming years? What else India need to do?
Well, it needs to maintain those very strong macro policies, the fiscal and the monetary. That's always a bit of a danger that either governments or central banks tighten too much or loosen too much. But I said in the report, in my 30 years of writing reports on India, I had never seen the macro environment look so good. And I think that the central bank and the finance ministry are in very good hands. So fingers crossed that continues to be the case. But I'm afraid the real answer to your question is the one that I've given to some of the other questions, and that's that doing business is still a challenging job in India. Expanding the company and increasing the workforce just potentially leaves you open to various restrictions and various regulations and various people coming into your workplace and potentially demanding money. That's what has to change, and that would be the biggest thing that could happen to India in the next 20 years. And I think the government's on it. I think when I spoke to my contacts in the government and the bureaucracy last year, I was really earlier this year, I was really impressed by what they were trying to achieve in terms of the task force that the central government put together, which would then go to each of the states and push for an upgrading of the various policies and systems that are in place at the state level. And they seem to have, I thought, a very good kind of understanding of where the problems were lying. And I don't know where that's gone at the moment. I haven't been back since February, but hopefully quite soon I'll be back in India, and that'll be the first question I'll be asking. How's the progress on that task force of making it easier to do business?
Thank you so much. And Reena, how do we allow some questions from audience? Shall I just read it? Sir, first question I will read for you is, how will a US slowdown impact the global economy? If there is a recession in US next year, what will be the implications for global economy?
Yeah, well, it's never particularly good for the global economy when the US slows down, because it is the biggest economy in the world. And I do think that we're highly likely to get a recession next year. In fact, the job market would kind of been saying to us that it's happening already. I know other things are not, but the job, certainly the stock market isn't. But the job market, I think, is struggling. What it means, it means less activity for everybody else as well. These things just spiral a bit. And it means the dollar will weaken. And that's something that we should keep in mind. The dollar has already been weak this year, but going into recessions, the dollar always weakens. And when I mentioned to you earlier that it was down 8% since Mr. Trump took office, it could easily be down another 8% and a bit more before the end of 2026. Now, the funny thing about that is that actually for emerging markets, that has traditionally been quite a good thing. The dollar weakening makes it much easier to service external borrowing, etc., actually makes the markets much more attractive, especially for US-based fund managers. So you can get this slowdown in the real economy, but actually a shift in assets to different countries into their asset economies. So it's not all bad news necessarily, but certainly the global economy, I think, will be a lot slower in 2026.
Sir, a US recession or a US dollar weakening, emerging market flows increasing. I just wish that it doesn't all pour in China and India remains high and dry.
Well, you know, the funny thing, Amisha, is that my boss came back from 3 weeks in the United States just this week. And the first thing he said at the morning meeting was that even though the Chinese market is up about 20% this year, especially the Hang Seng component of the China Enterprise Index, he said there was zero appetite for increasing exposure to China
Really?
from the Americans.
Yeah.
The politics are still too difficult for them in terms of their own business in America. So the good news is that I don't think all the money will be flowing into China. I think some of it will, but it might be from Europe. But I'm not worried about India in that respect, I've got to say.
So, you know, at this time when a lot of mutual fund flows are continuing by way of SIPs, and we also see a lot of new IPOs coming giving competition to secondary market. But in case the global flows revive, then large IPOs will be there to absorb, and then it can be even better for the markets. we
Should.
think. I'll just take up one more question, sir. Given the ongoing tariff wars and shifting trade dynamics between US, China, and India, which of these nations is most likely to consolidate superpower status in the coming years? And what key economic indicators should investors monitor to align their portfolios accordingly?
Well, hard question. I mean, it's easier for me to answer in terms of the country that I think that is going to lose influence because of its policies, and that is America. The inconsistency of policy thinking in the US just now is quite concerning, but basically it hands China and other countries big opportunities to become much more independent of a very difficult economic partner and political partner. I think that I'm amazed, but I'm really quite worried about what the Americans are doing just now and their influence in other countries to push them into taking stances against China or even India because it's been buying Russian oil. I mean, the one country that will follow anything that the Americans say is the United Kingdom. So goodness knows what's going to happen there because it's in a mess anyway. But economically, I mean, as I said earlier, and I showed you earlier, our analysis is based a lot on credit cycles, profit cycles, and investment flows. India still looks great in terms of those components. I think they're much, much better guides to the future and guides to long-term investing than industrial production, GDP, various other things that people look at every month or every quarter. They don't look particularly good for China at the moment. But I do think that China's right at the bottom of its profit cycle. So again, looking forward, I would say that this is the time to be increasing exposure to China and watching things like the credit figures, money supply numbers, the profit figures. But you don't need to rush. And this is what we've been saying to our clients, that you don't need to shift everything into China just now because it's going to take time and it might be a year to 2 years. But the factors that we look at for which are, as I say, much more kind of monetary orientated, are looking very good for India.
Sir, while I still have a little bit of time from you, I will have to say thanks to my co-host Anilji. As you know, he is typically and generally throughout the day live on his own channel.
Yes.
And thank you so much for sparing time in between and coming and also asking questions which really bothers even the retail investors and worded it so well. Thank you so much. And
Thank
in
you so
case
much,
your
Amisha.
time permits, you can ask, but otherwise, thank you so much.
No, I'm here for quite some time. Let me just spend some more time, maybe next 10 minutes or so. Yeah. Please go ahead.
Lovely, lovely, lovely. So there is, sir, one more question here that the world has seen deflationary cycle in last 15 years. Do you think we have reached the end of this cycle? When do you think the cycle will reverse to inflationary cycle?
Now,
Do you think that will happen or AI gains will continue to keep world?
Yeah, the funny thing is that I would kind of disagree with that analysis, that I think we've been in a horribly inflationary cycle for the last 15 years. I know economic policy has had settings that would say that we were in deflation, but the stock markets would tell a very different story.
Yeah.
And this is one of the kind of dangers, I think, of the concentration of attention on very specific variables like consumer prices. Consumer prices have been relatively contained over the course of the last 15 years, and in some instances, like China just now, consumer prices are falling. And everybody says that's deflation, but it's not. Deflation is when money supply falls. or credit in the economy contracts, and we have not been in that kind of environment at all for the last 15 years, quite the reverse. So I think that the problem is that we are likely, if anything, to move from an inflationary environment to one that's much more deflationary, especially in the West. And I mean by that containing government spending, money supply growth, and credit. So, I mean, I don't want to be pushing a very pessimistic view here, because I think other countries like India, where I've said that the macro policy making has been fantastic, the best in the last 30 years, has the opportunity to offset the problems from the United States and the advanced economies. If they're contracting money supply, India can actually expand it, as can some other emerging markets. But of course, it would be the news flow is always about the big countries. So there would be more negativity and pessimism around, I'm afraid, as a result of that.
Like in every statement of yours, I can feel the underlying belief in India's potential. Yes.
Yeah, it's been a constant theme for the last 4 years from us. I was very worried about the Indian economy in 2019 because I couldn't see any attempt to consolidate and recapitalize the banking system. That was achieved. And since then, India has just been and continues to be our top pick as a global strategy long. India, Vietnam, and China are now the 3 countries that we like most.
Would you be also sorry, Anilji,
Yeah,
over to you.
yeah, I want to ask one question. But Jim, does it frustrate you as well, like us? Like everything is right, everything is in place, still our markets don't perform, So people feel that, I mean, what do we do? I mean, we are not making money. Like economies like USA or markets like USA hitting highs and highs every day. On the contrary, India having everything right, but not performing. So that frustration.
I look at my own India investments, and they're all up. Now, they've been there for a wee while, but I'm very happy with my India investments. They're not up as much as the Mag 7 and what have you, but I think they're in just stratospheric territory. And, when people say to me, India's valuations are high, and then they tell me that they've got Nvidia, Alphabet, whoever the Mag 7 are. And I think, these companies don't make any money. They yield nothing when it comes to a return on the investment for dividends. And they're unbelievably expensive. And yet people say, oh, I can't buy India because of the valuations. It's nonsensical. But eventually common sense does prevail. And I think when that happens and people realize that they've been making some really bad investments in America over the course of the last few years, then the good quality companies that are making corporate earnings and have a growth story behind them are going to be the people who will benefit most. So I'm very confident in my investments in India.
And what about, sir, Mr. Warren Buffett has piled up so much of cash, probably lifetime high cash what he has with him as of now. So how do you see that actually? Do you think he'll get a good chance to deploy all that money at much, much lower levels in US markets?
I suspect he will. That would be, if we go into recession, he definitely will over the course of the next even 12 months. Unfortunately, I don't think he's ever been particularly interested in emerging markets. So I don't think we could make the case to him that,
Correct.
there's some good things staring you in the face just now. Bring your money over here. He'll wait for the correction in America.
Correct. Sir, one last question. How the US tariff and then the sanction tariff of another 25%. So now, compared to all the economies, we are the highest tax tariffed economy at 50%.
I know.
A, how do you think this whole equation will pan out?
Yeah.
And B, the way it gave way to GST reforms
Mm.
and opened up the domestic economy, it also actually apparently gave a way to a dialogue with China, opening up with China. How do you
Yeah.
think that opening up with China can play out?
Well, that's one of the things I'm most excited about in the last 3 months. A rapprochement between India and China would be gigantic for Asia. The two superstars of the region, mostly the world, when you think about their growth rates over the last 10 years, coming together and being much friendlier and trading much more and reacting with each other much more, I think would be great. That would be the best gift that Donald Trump had ever given the world. But the tariff side, I mean, who at the beginning of the year would have forecast that India would be facing 50% tariffs and China,
Absolutely.
we don't even know what the tariffs are for China, but less than that. I mean, it's so crazy. But this is the world that we live in when you have somebody that, as I say, is exceptionally unpredictable. But I think, in fact, I'm convinced that Mr. Modi will use the downside of that 50% tariff to transform the Indian economy.
So as such, it is 12 and your allocated time to us is complete. And it had been so good. But I tell you, for me, the highlight is we Indians now align ourselves with our leaders so much that when you praise that this is the best policy regime, frankly, we feel we are praised. We feel so
Absolutely.
proud. We feel so great. Thank you so much.
You deserve
And we
it.
will, yes, and we will make our efforts to further have a dialogue with you and make your 10 points agenda as to how do you think the golden knot can be cut further? What actually needs to be done on the ground so that India just opens up, fires, and the entrepreneurship really prospers. I'm going to get back to you, sir.
Very good. Thank
Thank you
you.
so much.
And thanks
Thank you so much,
thanks for
Anilji, for
asking me.
taking out this time.
Thank you, sir. Thank you, ma'am.
Pleasure.
Thank you. Thank you.
Thank you.
Thank you, Reena,
Thank
for
you.
all the effort. And
Thank
thank you,
you.
every participant.
Thank you, Anil sir.